$1 million is the number almost everyone eventually asks about, not because $1 million is magical, because it is large enough to change the structure of retirement. At that level, your money can begin doing a meaningful share of the work that your labor used to do. But there is a question most people ask too late. How much of that million must come from your own pocket, and how much can time do for you? That is the real retirement question. Most people think the main variable is income. Income matters. Most people think the main variable is which fund they choose. Funds matter. Most people think the main variable is return. Return matters too. But when I look at the system, I see that the most powerful variable is usually time. Time determines how much pressure you have to put on your paycheck. Time determines how much risk the portfolio must take. Time determines whether the market does most of the work or whether you have to do most of it yourself. And the difference between 30 years, 20 years, and 10 years is far more dramatic than most people expect. Let me show you what I mean through John. John starts from zero. No retirement account, no large inheritance, no head start. He has a regular job, a regular income, and until recently, he thought retirement was something other people somehow figured out. Then he runs the numbers. He asks the same question millions of people ask: what would it take to reach $1 million? That is the destination. And before we talk about the road, we have to understand what the destination means. There is a reason $1 million gets used so often in retirement planning. It connects to the 4% rule. The basic idea is simple. If John reaches $1 million in a diversified index fund portfolio, he can withdraw 4% in the first year of retirement. That gives him $40,000. Then in later years, he adjusts the withdrawal modestly for inflation and keeps going. The reason this can work is that over long periods, a productive portfolio has historically had the potential to grow faster than the withdrawal rate. So while John is taking income from the account, the portfolio can still keep compounding in the background. That is the point of investing. You do not spend your whole life building a pile of cash only to watch it shrink dollar for dollar once you stop working. You build an asset base that can continue producing while you draw from it. At $1 million, that first year withdrawal equals about $3,333 a month. If John later adds an average Social Security benefit of roughly $2,076 a month, he is looking at more than $5,400 a month in retirement income. That is why the $1 million mark matters in this example. It is not the only possible retirement number. It is simply a clean benchmark that lets us compare the cost of time, because John can reach the same $1 million destination three very different ways. One road gives him 30 years. One gives him 20 years. One gives him only 10. All three start at zero. All three use the same three Fidelity funds. All three arrive at roughly the same $1 million finish line. But the amount John has to contribute himself changes radically depending on how much time he gives compounding to work. That is the machine we need to understand. The three funds are simple. The first is FXAIX, the Fidelity 500 Index Fund. This is the broad foundation. It tracks the SP 500, which means it owns the largest public companies in the United States. It is not exciting, and that is precisely why it is useful. A long-term portfolio needs a core that does not require constant prediction. FXAIX has an expense ratio of about 0.02%, which is close to free by investment standards. And over the past decade in the source, it averaged about 12.97% in annual share price appreciation. That is the base layer. The second fund is FNCMX, the Fidelity Nasdaq Composite Index Fund. This one tilts John toward growth. Instead of tracking the SP 500, it tracks the broader Nasdaq Composite, which is heavier in technology, biotech, and companies that can grow faster but also move more violently. Over the past decade in the source, FNCMX averaged about 16.91% in annual appreciation. So it sits between the broad market foundation and the aggressive edge, more growth, more volatility. The third fund is FSELX, the Fidelity Select Semiconductors Portfolio. This is the most aggressive of the three. It focuses on semiconductor companies, the chip makers behind phones, laptops, data centers, and AI systems. Over the past decade in the source, it averaged about 22.04% in annual appreciation. That is an extraordinary number. It is also the reason this fund carries the most risk in the portfolio. Semiconductors are cyclical. When the industry falls, it can fall hard. But when John shortens the time available to reach a large goal, the portfolio has to work harder, and FSELX becomes the engine that provides the extra growth potential. This is an important point. The same funds can be used in all three plans. What changes is not the toolkit. What changes is the weighting. Time determines the amount of aggression required. The more time John has, the less he needs to lean on the riskiest growth engine. The less time he has, the more he has to concentrate in higher growth assets and the more of his own paycheck he must contribute. That is the trade. Let us begin with the 30-year path. This is the easiest version mathematically because time does the heavy lifting. With 30 years available, John does not need to build the most aggressive possible portfolio. He can use a 60% allocation to FXAIX, 30% to FNCMX, and only 10% to FSELX. The broad market is doing most of the work. The NASDAQ adds a growth tilt, the semiconductor fund adds a smaller dose of upside without letting the whole system become dependent on one sector. When those three allocations are blended together, the portfolio in the source produces an estimated dividend yield of about 0.81%, dividend growth around 6.18%, and annual share price appreciation a little over 15%. The yield is not the major driver here, it does not need to be. With 3 decades available, capital appreciation and time are the dominant forces. Now look at what John has to contribute, $6 a day. That is it. About the cost of a small breakfast. This is why time is so powerful. With enough time, the daily burden looks almost trivial. By the end of year 1, John's account is around $2,190, which is basically what he contributed. That is normal in the beginning. The account is mostly contributions because the base is still small. By year 10, the account is projected to be around $45,641 by year 20, around $234,158. And by the end of year 30, the account reaches about $1,004,150, a little over $1 million from $6 a day. Now look at the most important part over the full 30 years. John contributes only $65,700 of his own money. The other $938,450 is created by the market and the time he gave it. That is compounding in the 30-year version. John is not really the one building most of the wealth. He is the one consistently placing the first bricks. Time builds the cathedral. This is how long-term investing is supposed to work. You provide the discipline, the market provides the multiplier. But that only happens when you start early enough and stay with the system long enough. The 30-year plan reveals the cleanest form of the compounding advantage. For every dollar John contributes, the market gives him roughly $14 back by the end. That is not because the daily amount is large, it is because the runway is long. The longer the runway, the more generations of growth occur before the finish line. That is what people often miss when they delay investing. They do not simply lose the money they would have contributed. They lose the years those early dollars could have spent reproducing. Now let us shorten the runway. Suppose John does not have 30 years. Suppose he has 20. The destination remains $1 million. The funds remain the same, but the math changes immediately. Now FXA drops from 60% to 35%. FNCMX rises to 40% and becomes the largest piece of the portfolio. FSELX rises from 10% to 25%. The reason is not mysterious. John has taken away 1/3 of the time. The portfolio has to compensate. So the broad market foundation becomes smaller, and the more aggressive growth engines carry more of the load. The new blended portfolio has a dividend yield of about 0.58%, dividend growth around 5.16%, and annual share price appreciation of roughly 16.81%. The yield falls, the dividend growth rate falls, the appreciation rate rises. That is the trade. John is choosing less time, more growth pressure, more volatility, more money from his own pocket. Now the daily contribution is no longer $6, it is $22 a day, about $660 a month, about $8,030 a year. That is still possible for many households, but it is no longer almost invisible. Now the plan demands real behavioral change, a few fewer restaurant meals, a smaller car payment, subscriptions that are canceled instead of forgotten, a budget that has been organized around a goal instead of around convenience. By the end of year 1, John's account is around $8,030. Basically what he contributed. By year 10, the account is projected to reach about $180,684. By the end of year 20, it reaches about $1,040,920 again, the same finish line. But notice what happened to the contribution burden. In the 30-year plan, John only had to contribute $65,700 across 3 decades. In the 20-year plan, he contributes $160,600. He has taken 10 years away from compounding, and the cost of buying those years back is roughly $95,000 more from his own paycheck. That is the hidden cost of delay. People think waiting 10 years means they only lose 10 years. They also increase the amount of labor that must replace the lost compounding. The market still does most of the work in the 20-year version, but not nearly as much as before. For every dollar John contributes, the market now gives him about $5.5. That is still powerful. But compare it with the $14 the market gave him in the 30-year plan. Same million-dollar goal, same funds, same basic process. But less time means a much worse bargain. This is why I say time is not free, but it is the cheapest retirement money available. You can buy back lost time only by contributing more, taking more risk, or both. Now we come to the 10-year version. This is the plan that attracts the most attention because it promises the fastest result. But the system does not give speed away for free. A 10-year goal from $0 to $1 million requires a completely different level of intensity. The portfolio becomes far more aggressive. FXAIX drops to only 15%, FNCMX sits at 35%. FSELX becomes half the portfolio at 50%. Now half of John S. retirement plan is concentrated in one sector. That can work if the sector continues compounding strongly. It can also create much larger drawdowns if the semiconductor cycle turns against him. That is the price of speed. With only 10 years to reach $1 million, the broad market alone cannot reasonably be asked to do enough. John needs a portfolio with far more growth potential. So the blended dividend yield falls to about 0.34%. Dividend growth falls to about 3.44%. But annual share price appreciation rises to about 18.88%. The highest of the three portfolios, and now comes the number almost everyone underestimates. John must invest $120 every single day. That is $43,800 per year, about $3,650 per month every month. For 10 years, this is where the fantasy ends and the math begins. Most people cannot do this on an average income. The source correctly says that, realistically, this requires a household income around $120,000 or more because after rent, food, taxes, and ordinary life, $3,650 a month into investments is not a casual commitment. If that is not John S.'s situation, the 30-year or 20-year version is not a failure. It is simply the version that fits reality. A good financial plan is not the most aggressive plan. It is the plan you can actually live with for the full duration. That is a very important distinction. The 10-year plan can reach the destination, but it does so by demanding three things at once: a very high savings rate, a very aggressive portfolio, and the emotional ability to tolerate concentration risk by the end of year one. John S. account is around $43,800. Again, mostly his own money because compounding has barely had time to work. By year 5, it grows to about $320,168. By the end of year 10, the account reaches about $1,083,063 of that total. John himself contributed $438,000. The market contributed about $645,063. The market still does more work than John, but only barely. In the 30-year plan, compounding overwhelmingly carried the result. In the 10-year plan, John is nearly matching the market dollar for dollar. That is the cost of taking away 20 years of runway. You can still get there, but you pay for the missing time with your paycheck and with risk. This is the central lesson of the whole system. The destination can be the same. The burden is not. All three paths end around $1 million. But the effort required from John is completely different. In the 30-year version, he contributes $65,700. In the 20-year version, $160,600. In the 10-year version, $438,000. The 10-year version requires almost 7 times as much of John S.'s own money as the 30-year version. Same destination, very different cost. And the ratio of market help changes just as dramatically. In the 30-year plan, each dollar John contributes is matched by about $14 from the market. In the 20-year plan, each dollar produces about $5.5 from the market. In the 10-year plan, each dollar produces only about $1.5 from the market. That is what the numbers are really teaching. Time is not a background detail. Time is the most efficient capital source in retirement planning. The less time you give your money, the more money you have to provide yourself. The more time you give it, the less pressure you place on income, spending, and risk tolerance. This is why starting early matters so much. People often hear that advice and treat it like a moral lecture. It is not a moral lecture, it is arithmetic. A person who starts early does not have to be richer. They do not have to be smarter. They do not have to pick more exciting funds. They simply let the market work for longer. That is enough to change the entire equation. Now, the three portfolios also reveal another principle. The shorter your timeline, the more concentrated the portfolio becomes. That should make you pause. When you have 30 years, John can use 60% broad market exposure and only 10% semiconductors. When he has 20 years, semiconductors rise to 25%. When he has 10 years, semiconductors rise to 50%. The need for speed creates the need for concentration, and concentration creates fragility. If the semiconductor cycle performs exceptionally well, the 10-year plan has a path. If it suffers a severe down cycle at the wrong time, the plan becomes much harder. That is not a criticism of semiconductors. It is simply risk reality. The more dependent a plan becomes on one high-growth engine, the more the outcome is tied to that engine continuing to deliver. A long runway lets you diversify more. A short runway often tempts you to concentrate more. This is why people should not casually say they want to retire in 10 years without asking what that demand does to the portfolio. A shorter timeline is not just a motivational slogan. It changes the entire architecture of the plan. The contributions become larger, the risk becomes higher, the margin for error becomes smaller, the emotional pressure increases. If John can do it, good, but he should understand exactly what he is choosing. The plan must fit his real life. A beautiful plan that cannot survive ordinary months is not a plan. It is a fantasy. That brings us to one of the most important points in all of investing. The best portfolio is not the one with the highest theoretical return. It is the one you can actually hold long enough for the return to matter. If John chooses the 10-year portfolio because he loves the idea of reaching $1 million quickly, but then panics during a semiconductor drawdown and sells after a major decline, the plan fails. If he chooses the 30-year portfolio and steadily contributes $6 a day for decades without interruption, the plan may succeed with far less stress. Returns matter, behavior matters more than most people realize. A portfolio does not only need to be mathematically sound, it must be behaviorally sustainable. This is why I think in terms of systems, a good system aligns with the person using it. If John has 30 years, a 30-year plan may be ideal. If he has 20 years and can invest $22 a day consistently, that may be the right system. If he truly has the income, discipline, and risk tolerance for $120 a day and a highly aggressive allocation, then the 10-year plan may fit. But no version is morally superior. They are simply different trade-offs. The important thing is not to choose the most impressive plan. The important thing is to choose the plan that John can actually execute, because execution is what compounds. Plans do not compound, actions do. Now let us return to the million-dollar destination one more time. At $1 million, using the 4% rule, John can withdraw about $40,000 in the first year of retirement. That is $3,333 a month from the portfolio. When combined with roughly $2,076 of Social Security, his monthly income is a little over $5,400. The reason that matters is not that everyone needs exactly the same retirement income. They do not. The reason it matters is that $1 million turns retirement from a vague wish into a measurable system. Once you have the target, the timeline, the funds, and the required contribution, the fog clears. You can stop saying, I hope I retire someday. You can begin saying, this is the trade I must make. If I want 30 years, the daily cost is $6. If I want 20 years, the daily cost is $22. If I want 10 years, the daily cost is $120. That is clarity. And clarity is powerful because it replaces anxiety with decisions. John may discover that 10 years is unrealistic. That is useful information. He may discover that 20 years is possible with spending changes. That is useful information. He may discover that 30 years is easy if he starts now. That may be the most valuable information of all. Because starting early converts what looks impossible later into something manageable. Now this is why delay is so expensive. Delay makes later versions of the plan look heroic. Starting early makes the same goal look ordinary. A $6 a day plan is not heroic. That is the point. Good financial systems should not require heroism every month. They should make the right action repeatable. Now, there is another lesson hidden in the three funds themselves. FXAIX is the broad foundation. FNCMX is the growth tilt. SELFS is the aggressive engine. Every portfolio needs to balance stability, growth, and risk according to the timeline. In the 30-year version, stability and breadth dominate. In the 20-year version, growth becomes more important. In the 10-year version, aggression becomes unavoidable. This is a useful way to think beyond these exact funds. The allocation should reflect the objective and the time available. People often copy a portfolio without understanding why the weights exist. That is dangerous. The same fund mix can be reasonable for one person and reckless for another depending on horizon, cash flow, and emotional capacity. John's 50% FSELX allocation is not simply a better version of his 10% allocation. It is a very different bet required by a very different deadline. Deadlines change risk. That is another core principle. The more fixed and near the deadline, the less room you have for adverse outcomes. A 30-year investor can survive long drawdowns and still recover. A 10-year investor with half the portfolio in semiconductors has far less room for a bad sequence of returns. That does not make the plan impossible. It makes it demanding. And demanding plans require honest self-assessment. Can you contribute that much every month? Can you hold through large drawdowns? Can you avoid changing the strategy halfway through? Can you maintain the income required? Can you keep the spending discipline? If not, the faster plan may actually be slower because it collapses under its own demands. The sustainable plan is often the fastest plan that actually gets completed. Now, the source ends by comparing Fidelity with Schwab, but the deeper message has already been delivered before that point. The provider matters, fees matter, fund selection matters. But the largest lever in this story is still time. You can optimize the brokerage, you can compare funds, you can shave tiny differences in expense ratios. Those things matter. But if you delay the start by 10 years, no small fee advantage will save the plan. First, solve the biggest variable start. Then contribute consistently. Then choose a structure that fits the timeline. Then let the market work. This is how wealth is built, not through guessing, not through constant switching, not through pretending that you can compress decades into a few months without cost, through understanding the trade-offs and acting accordingly. If John gives compounding 30 years, the market does almost everything. If he gives it 20 years, the market still helps greatly, but he must do more. If he gives it only 10 years, he can still reach the goal. But now his own savings effort and portfolio aggression must rise dramatically. That is the whole lesson. Time is not passive. Time is capital. Time is the cheapest contribution John will ever make. Every year he gives the portfolio reduces the burden on future John. Every year he delays increases the price of the same dream. That is why the person who starts earliest often looks lucky later. They are not lucky. They bought time while it was still cheap. The question for John is not simply how fast he wants $1 million. The question is what kind of daily life he is willing and able to sustain to get there. $6 a day for 30 years, $22 a day for 20 years, $120 a day for 10 years. All three work on paper. Only one will match his actual life. The right answer is not the fastest one. The right answer is the one he can execute consistently enough for compounding to finish the job. That is the principle I would want him to understand. The $1 million goal is not won by enthusiasm on day one. It is won by repeated behavior matched to a realistic timeline. And if he starts early enough, the most powerful investor in his portfolio will not be John, it will be time.